You know, people ask me all the time what my secret is. They want to know how a kid from Omaha ended up with one of the most successful investment records in history. And I'll tell you what I tell everyone else. There is no secret. What I do, anyone can do. The real question is whether you're willing to be rational and patient in a world that rewards neither. Today, I want to talk about something fundamental to everything I've done over 7 decades of investing. I want to explain value investing versus growth investing and why I've always chosen value. This isn't going to be some dry lecture. This is a story about human nature, about markets, and most importantly, about understanding yourself as an investor. Let me take you back to a moment that changed everything for me. I was 19 years old, sitting in a classroom at Columbia Business School, and my professor was a man named Benjamin Graham. Ben wasn't like other professors. He didn't fill our heads with fancy formulas or abstract theories. He taught us something far more valuable, how to think about stocks as pieces of real businesses, not lottery tickets. Ben Graham introduced me to value investing, and that single encounter shaped my entire career. His idea was beautifully simple but profound. Every stock represents ownership in a real business, and that business has intrinsic value based on its assets, earnings, and future prospects. The stock market, he explained, is like a voting machine in the short term. Prices bounce around based on emotion, fear, and greed. But in the long term, the market is a weighing machine. Eventually, price converges with value. His advice was revolutionary in its simplicity. Find businesses trading for less than they're worth, buy them, and wait for the market to catch up. That's value investing explained in one sentence, and it became the foundation of my Warren Buffett investing strategy. Now, what exactly is growth investing and how is it different? Growth investing focuses on companies expanding rapidly, increasing sales and earnings at above average rates. Growth investors are willing to pay premium prices for these companies because they believe future growth will justify today's high valuation. They're buying potential, betting that a company growing 30 or 40% a year will continue doing so and eventually make today's price look cheap. Here's the thing, they're not always wrong. Growth investing has worked spectacularly for some people. If you'd bought Amazon in the late 90s or Apple before the iPhone, you'd have made extraordinary returns despite paying prices that looked outrageously expensive by traditional value metrics. So why don't I do it? Why have I spent my entire career focusing on value investing when growth investing has produced some of the biggest winners in market history? The answer gets to the heart of what investing is really about. When I look at a growth stock trading at 50 or 100 times earnings, I'm being asked to predict the future with certainty I simply don't possess. I'm being asked to believe this company will keep growing at extraordinary rates for years. I'm being asked to assume competitors won't appear, technology won't disrupt the business, management won't stumble, and growth won't eventually slow down as it always does. That's a lot of things that have to go perfectly right. Value investing is different. It's about margin of safety, another concept from Ben Graham that might be the most important lesson I ever learned. When you buy a stock for significantly less than its intrinsic value, you're building in a cushion against inevitable uncertainties. You're not trying to predict the future perfectly. You're saying, this business is worth $1, I can buy it for 50 cents, and even if I'm somewhat wrong, I'll probably still do okay. That margin of safety is what gives me confidence and reduces risk while maintaining upside potential. Let me give you a concrete example of value investing in action. Back in the early 70s, I started buying the Washington Post Company. This wasn't some exciting growth story or hot technology stock. It was a newspaper company about as old economy as you could get. But here's what I saw. The Washington Post had a dominant position in the nation's capital. It owned television stations. It generated substantial cash flow, and it was run by Katharine Graham, one of the most capable executives I've ever encountered. I calculated the company's intrinsic value at around $400 to $500 million. The entire company was trading in the stock market for about $80 million. Now, a growth investor might have looked at newspapers and seen declining readership and said, no thanks, I want something growing faster. But I wasn't trying to find the fastest growing company in America. I was looking for a great business at a substantial discount to its worth. Over the next decade, our investment multiplied many times over. We didn't need newspapers to become a high-growth industry. We just needed the market to recognize what the business was actually worth. Here's another way to understand the difference. Value investing is like buying a dollar for 50 cents. You're getting something today that's clearly worth more than you're paying. Growth investing is more like buying a dollar that might become $5, but you're paying $3 for it today. You need that growth to materialize and be substantial enough to justify the premium. Both can work, but they require different mindsets. The value investor needs to analyze businesses, understand financial statements, calculate intrinsic value, and have patience to wait for the market to recognize value. The growth investor needs to identify trends early, understand which companies will dominate emerging markets, and have conviction strong enough to pay high prices for uncertain futures. I've always believed I'm better at the former than the latter. I'd rather be approximately right about value than precisely wrong about growth. Now here's something that confuses people about my own investing. Some think value investing means only buying cheap, beaten-down stocks, while growth means buying expensive, fast-growing companies. But that's oversimplified, and my own evolution as an investor proves why. When I was younger, deeply influenced by Graham, I focused on what we call deep value stocks. Companies trading below their liquidation value, cigar butts you could buy cheaply and get one last puff. I made money doing this early on, but I realized it had limitations. You were buying mediocre businesses at bargain prices, and mediocre businesses have mediocre results even when bought cheaply. Then I met Charlie Munger. Charlie became my partner and closest collaborator, and he taught me something crucial. He said, "Warren, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." That sounds simple, but it was profound. Quality matters enormously. A great business with durable competitive advantages and excellent management will compound your wealth over time in ways a cheap, mediocre business never will. This is where people get confused about Buffett's investment philosophy. They think I abandoned value investing when I bought companies like See's Candies, Coca-Cola, or more recently, Apple. They say, "Warren's become a growth investor." But that's not accurate. I'm still doing value investing, just a more sophisticated version. I'm looking for companies with intrinsic value exceeding their market price, but now I'm factoring in sustainable competitive advantages, strong brands, high returns on capital, and growth potential. I'm still buying value, but recognizing that value includes the ability to grow and compound over time. Let me tell you about Coca-Cola, because it perfectly illustrates this evolution in my thinking. In 1988, I started buying Coca-Cola stock. By traditional metrics, it wasn't dirt cheap. But here's what I saw. Coca-Cola had the most valuable brand in the world, a product people had loved for over a century, distribution reaching almost every country, and the ability to raise prices gradually over time. Most importantly, it had what I call an economic moat, a durable competitive advantage protecting it from competitors. When you factored in the franchise value, cash generation ability, and international growth prospects, Coca-Cola was undervalued even though it didn't look statistically cheap. Over the next decade, we made billions on that investment, not because I predicted every twist in the soft drink industry, but because I bought a great business at a price below its true worth. That's value investing. It's not about finding statistical bargains on a computer screen. It's about understanding business value in all its dimensions and paying less than that value. Now contrast that with what happened during the late 90s dot-com bubble, one of the most extreme examples of growth investing run amok. People were paying astronomical prices for internet companies with no profits, no path to profitability, and business models that made no sense. The prevailing wisdom was that traditional valuation didn't matter anymore, that we were in a new economy where old rules didn't apply. I set out that party entirely, and boy did I take criticism for it. People said I was too old, that I didn't understand technology, that I was missing the greatest investment opportunity of our lifetimes. Berkshire Hathaway significantly underperformed as tech stocks soared. Some questioned whether value investing still worked. But I stuck to my principles because they were based on something timeless, business fundamentals. I kept asking, what is this company actually worth based on the cash it can generate over its lifetime? And when I did that analysis for most internet stocks, the numbers made no sense at any reasonable valuation. You know what happened next. The bubble burst, as bubbles always do. Trillions in market value evaporated. Companies worth billions went to zero, and suddenly the old-fashioned notion that you should pay less for a business than it's worth looked pretty smart again. This brings me to a critical point about value investing and stock market wisdom. It requires patience and the emotional fortitude to look foolish in the short term. Value investing doesn't always work immediately. Sometimes you buy something that keeps declining. Sometimes the market ignores your analysis for years. Sometimes you sit on the sidelines during bull markets watching others profit while you wait for opportunities meeting your standards. This is psychologically difficult, and it's why more people don't succeed with value investing even though the principles are simple. I've said many times that the stock market is a device for transferring money from the impatient to the patient. That's especially true comparing value and growth approaches. Value investors make money through patience, waiting for recognition of value. Growth investors can profit too, but they're often relying on continued enthusiasm from other investors and favorable market conditions. When conditions change, growth stocks can decline precipitously even if the business performs well, simply because expectations were too high. Let me give you some beginner investing tips for deciding between these approaches. First, understand your own temperament. Are you comfortable being contrarian, buying what others are selling, sitting patiently while others profit from speculation? If so, value investing might suit you. Do you prefer investing in exciting industries and companies even if they're expensive? Are you confident identifying growth trends early? Then growth investing might fit better. There's no universally correct answer. The best approach is one you can stick with through various market conditions. Second, understand your time horizon. Value investing is inherently long-term. You're buying something undervalued and waiting for the market to recognize its worth, which might take years. Long-term investing is essential for both approaches, but it's especially critical for value investors who must wait patiently for value recognition. Third, consider your circle of competence. This concept is crucial to my philosophy. Invest in businesses you understand, in industries where you can evaluate competitive dynamics and reasonably assess value. For me, that's meant avoiding most technology stocks, not because they're bad investments, but because I don't feel I understand them well enough. Know what you know and stay within those boundaries. Here's something I've learned over 7 decades. The distinction between value and growth investing is somewhat artificial. All good investing is value investing in the sense that you should only buy when value exceeds price. The question is how you calculate value. Traditional value investors focus heavily on current assets and earnings. Growth investors factor in anticipated future growth. They're not ignoring value, they're defining it differently. My approach has evolved to incorporate the best of both perspectives. I look for what I call value with growth. Businesses undervalued based on current fundamentals, but also able to grow and compound over time. That's the sweet spot. Think about American Express, which we've owned for decades. It wasn't the cheapest stock when we bought it, but it had a valuable franchise, strong economics, and growth potential while trading below what we calculated it was worth. The same is true for Apple, now Berkshire's largest equity holding. Some were surprised when I bought it. Warren doesn't buy technology, and Apple is expensive, and they said. But I saw a company with enormous customer loyalty, an ecosystem creating switching costs and recurring revenues, tremendous profitability, shareholder-friendly capital allocation, and despite its size, room to grow. Was it cheap by traditional value metrics? No. But factoring in business quality and economic characteristics, it was undervalued. That's the value investing I practice today. Now, does value investing still work in today's market? And I get this constantly. People point out that technology companies dominate, that intangible assets matter more than tangible ones, that the economy has changed in ways favoring growth over value. They ask whether my approach, rooted in principles from the 30s and 40s, remains relevant in the 21st century. My answer is emphatically yes. The principles of value investing are timeless because they're rooted in logic and human nature, neither of which changes. The idea that you should pay less for something than it's worth, that you should have margin of safety, that you should think long-term and be rational when others are emotional. None of that has become obsolete. What has changed is how you identify value in a world where many valuable companies have few physical assets and most worth is tied to intellectual property, brands, networks, and data. But those intangible assets create value just like tangible assets do. They just require different analytical approaches. When I evaluate Apple, I'm not looking primarily at factories or inventory. I'm looking at brand, ecosystem, customer loyalty, cash generation ability, and competitive position. Those are the assets that matter, and they create real value that can be analyzed and quantified with different tools than analyzing a steel company. The real question isn't whether value investing works anymore. It's whether you're willing to do the intellectual work required to identify value in its various forms. Many investors want shortcuts, screens, and formulas spitting out lists of value stocks they can buy without thinking. That never worked well, and it certainly doesn't work now. Value investing requires judgment, understanding businesses, thinking about competitive dynamics and earning sustainability and management quality. That's harder than running a stock screen, but it's what leads to superior returns. Let me share some practical wisdom. First, learn to value businesses. This doesn't require advanced mathematics. It requires understanding what creates value, sustainable competitive advantages, cash generation ability, favorable economics, capable management, and reasonable growth prospects. Read annual reports, study companies, think about why customers buy their products. Consider what happens if prices increase or competitors enter. Develop intuition for what makes a good business. Second, be patient. Value investing opportunities don't present themselves constantly. Sometimes the market is fairly priced and there's nothing compelling to buy. That's okay. Sit on cash and wait. Don't feel obligated to be invested at all times. Some of my best years have been when I didn't do much of anything, just waited for the right opportunity. Third, think independently. Don't follow the crowd. I've seen so many fads come and go. Each time the crowd convinced itself this was different, that old rules didn't apply, and each time it ended badly for those who paid inflated prices. Value investing requires being comfortable looking different, even foolish in the short term. But if you're right about value, if you've done your homework and maintained margin of safety, time will prove you right. I want to close with this thought. My investment philosophy is really a life philosophy. It's about rationality, integrity, patience, and focusing on what matters. I've structured my life to spend time on things I find meaningful and enjoyable, surrounded by people I like and trust, doing work I love. That's true success, and it's available to everyone, regardless of wealth. In investing, as in life, I've kept things simple. I don't use complex derivatives or sophisticated trading strategies. I don't try timing the market or predicting short-term movements. I don't follow elaborate economic forecasts. Instead, I focus on understanding businesses, buying them when attractively priced, and holding them while they compound in value. That's not exciting or glamorous, but it works because it's based on sound reasoning rather than speculation. The beautiful thing about value investing is this: it aligns you properly with markets and with reality. You're not trying to outsmart traders or catch momentum. You're simply evaluating businesses and waiting for opportunities when the market offers them at attractive prices. Sometimes those opportunities are plentiful, like during the 2008 financial crisis. Sometimes they're scarce, like in bubble markets when everything seems overpriced. The value investor doesn't force things. We wait, and when opportunities appear, we act decisively. I've made plenty of mistakes over the years. I bought businesses I thought were undervalued that turned out to be deteriorating faster than I realized. I've held declining businesses too long hoping they'd recover. I've missed opportunities being too conservative. No approach eliminates mistakes. The question is whether your framework helps you make good decisions more often than bad ones and helps you avoid catastrophic errors. Value investing does that for me. It provides a framework for analysis, discipline for decision making, and a temperamental match for how I think about uncertainty and risk. It might not be right for everyone, but it's been right for me, and I believe it's sound for any long-term investor willing to do the work. So here's my final advice. Be patient, be rational, stay within your circle of competence, and always maintain margin of safety. Don't try to get rich quick. Focus on not losing money and the gains will take care of themselves over time. Remember that in investing, as in life, the tortoise beats the hare. Slow and steady, with discipline and patience, wins the race every single time. The market will offer you wonderful opportunities if you're prepared and patient. Your job isn't to swing at every pitch, it's to wait for the right pitch, the one you understand, the one where the odds are heavily in your favor. And when that pitch comes, swing hard. That's value investing. That's how you build wealth that lasts. And that's why, after more than 70 years of investing, I'm still choosing value every single day. Remember to like and subscribe for the best investment strategies and advise inspired by Warren Buffett. Listen to our next audiobook in the series now.